This video is for information purposes only, and the information is from research I have done from the internet. Please do your homework and make the right decision for you. To understand credit cards, we need to understand fees that are charged, minimum payments, interest-free periods, and interest rate charges and billing cycles. In this video, I'll be discussing some of the fees that are included in your credit card charges. I'll be doing other videos to discuss the other elements, so please look out for those. Debit card payments come off a current account, while credit card payments are made using credit, which you'll have to repay with interest later. A minimum payment refers to the smallest amount due every month on your card, based on a percentage, usually 3 to 5% of the capital. The minimum payment tends to include interest for the month, potential charges for default payments, and if there are any annual fees, part of that might be included as well. Credit card issuers charge interest only if you carry your balance from one month to another. If you pay your balance in full every month, your interest rate is irrelevant because you don't get charged interest at all. It's important to know the exact payment due date so that you can pay your balance in full and avoid incurring any interest. If you don't pay off your credit card in full every month, you'll be charged interest on the balance. Usually the annual percentage rate is between 9 and 20.5%, but credit card interest is actually calculated on a daily basis, depending on your loan agreement. This can be compounded daily or monthly. Compounding means that interest charged on a daily basis is added to your loan amount every day or every month, and then the interest charged in the following month or following day is then based on that new balance. 9% is the lowest interest rate you can pay on a credit card compared to the highest rate of 20.5%. To help our pockets, we need to consider interest-free period to make full payment. What that means is that you will be charged interest on interest if you allow it to roll over from one month to the next. Again, we should always aim to pay off our credit card in full every month. One of the ways to establish a credit score and the most popular option is to get a credit card. If you spend responsibly on the credit card and repay it every month, you're likely to see a positive trend in your credit score. However, if you max out your card every month and only make minimum repayments, you could damage your credit score. Here are some of the credit card fees that can be in the pre-agreement form. Interest payments. Credit cards can have different interest rates for till points and ATM withdrawals. When you pay in full every month, your purchases don't accrue interest. Initiation fee is a once-off fee that your credit card provider will charge you to enter into a credit agreement. Many, but not all credit card providers involve an initial once-off fee when you open an account. Service or a monthly account fees is a fee that credit card providers charge you for servicing, administrating, or maintaining the credit agreement. Credit providers can charge this on a monthly, annual, or per transaction basis. Reward program fees. International transaction fees. Credit cards can be used overseas and offer an easy cashless option for travel. However, international transaction fees will apply, and these can be quite pricey. There can also be additional fees for late payments, withdrawing cash, balance transfers, and going over your credit limit. It's a good idea to find out exactly what these are for your specific card. When you're approved for a credit card, the bank authorizes a credit card limit. This is the maximum amount available on your credit card. Your credit card limit will depend on factors like your income, your other debts, payment history, and how much available credit you have on other cards. At the end of each month, you'll have the option of paying a certain minimum amount or paying the whole balance in full. Paying just the minimum amount every month is ultimately the most expensive option because it will cost you more in interest. When you pay in full every month, you'll get a grace period that allows you to avoid paying any interest on your purchases. You must pay at least the minimum by the due date every month to avoid late fees and potential damage to your credit score. Should you fail to make payments on time, your bank will report you for non-payment to the credit bureaus. The advantages of having a credit card is that it's easier to carry than cash and offers greater security than cash and can be used to strengthen your credit score if used wisely. Make sure you pay your outstanding balance on your credit card every month. Look into credit offers from your bank that include long interest-free credit periods. These can be up to 55 days. We can then use the interest-free period for purchases and settle the balance in full every month without paying any interest. According to the National Credit Regulator, the maximum interest rate on a credit card is 20.5% and the maximum interest rate on personal loans is 27.5%. From this, we can see that credit card rates are relatively lower than interest rates on personal loans. Interest rates offered are dependent on an individual's risk profile. A credit card may come at a lower interest rate than a personal loan if you need to apply for credit. In my next videos, I'll be talking about minimum installments, interest rates and other charges, a bank's billing cycle, and interest-free period. Please look out for those videos. Thank you for watching and goodbye.